And Randy, it's so nice to see you all. Thank you for joining us. I was just saying I'm fairly new to Zoom, as in, I know that sounds ridiculous because we've been on Zoom for how many months now, but I don't use it as my preferred. Now I do, but I was Google Meets forever. So we are just going to have some people trickle in, but I had Monica just take over as host so that she's able to present her screen and share with us today. Monica is from CMHC, and she is going to give us a market update. And we do also have Krista Wilkins, here as well from First National, who is one of our preferred lender partners. And she is going to be here to answer any questions, supporting in general each other, because we all work hand in hand to really help our clients. And CMHC is a great resource of information. So over the next little while, we're going to have people trickling in. I am having the session recorded. However, that is for kind of the YouTube users afterwards if anyone missed the session. And then we'll just have questions at the end if that's okay. We'll kind of jump right into it. So thanks everyone for joining. I'm going to go on mute because Monica really is the wealth of knowledge, and Krista is going to be here to support. Like I said, if there's any specific questions to a particular lender guideline that is of your curiosity. So thank you so much, Monica.
My pleasure. Thank you so much. I just want to confirm I clicked recording to cloud. Does that mean you get it? I hope. Okay, great. Thank you so much for having me out today. In terms of what we do at CMHC, it's such a turbulent time for so many people. There's a lot of fluidity in the market. There's a lot of changes happening super quickly. We've got a wealth of information available on our cmhc.ca webpage, but I thought I'll bring forward today just a few components. So I'm just going to share my screen and see if all this will work. There we go. Share screen. I'll tell you a little bit about myself. So I started with CMHC in 2006. Let's hope this works. Here we go. In 2006, and I came from a banking background as well. So I've kind of been through, a lot of the changes that we all know about, like the changes to the minimum purchase price in Canada for CMHC or mortgage loan insured deals. We've been around for all the changes to GDS and TDS back and forth and whatnot. One of the things I think we pride ourselves in is just being a partner that you can rely on. And even though there are so many changes happening, I think what's important is that CMHC remains constant. We're here to support not only our lender clients, but also our broker partners as well, because you truly touch Canadians on a daily basis. You work with the clients that are enduring, one of the biggest decisions of their lives, and that's moving into home ownership. But before I even talk about that, I wanted to bring forward one of the things that really makes me sleep at night and makes me proud every morning when I get up and turn on my computer. And that's working for an organization that truly supports housing in Canada in a way that really breaks down some of the barriers that we've seen in the past. So housing isn't just purchase per se. Housing is really all about a variety of different components in the housing continuum. So when it comes to our mandate, which is everyone in Canada by 2030 will have a home that they can afford and one that meets their needs, that truly does resonate with me, because it allows us to look at all aspects of this housing continuum. And I know many of you really do truly work around the home ownership aspect, but CMHC has a variety of different programs that are there to support affordable rental. We provide funding and support for homeless shelters and emergency shelters, transitional housing, social housing as well. And our goal as part of the National Housing Strategy is to reduce homelessness by 50%. So we do that in the form of a variety of different programs. So the National Housing Strategy, for those of you that know about it, is a $72 billion plan, 10-year plan that really focuses on reaching that aspiration, ensuring that everyone in Canada has a home that they can afford and one that meets their needs. And unfortunately, with the changing environment, both on the interest rate side, but also on the affordability side and the way the housing market is going, it's actually making it harder and more turbulent for those trying to reach home ownership, or even just trying to have access to rental housing. So affordability has actually worsened. And one of the things I wanted to share with you guys today is really looking at, some of the articles. There's a lot of data and research that CMHC does. Again, I'm not an economist by any means, but I can share the information that we've published and that we're processing. And that really is looking into, different aspects of housing, why, what impacts the interest rates have had, et cetera. So here is just some key economic data that we put together. Changes are happening so quickly. Actually, this actually needs to be even updated. Yeah, changes are happening so quickly that, the reality is, the goal of interest rate going up and down is really just to drop that inflation rate. Is to bring it down. One of the things we've been listening to, it was also part of the Mortgage Professionals Canada National Conference, and Benjamin Tal was speaking. So I jotted down some various notes, and it's really, looking back at history too, right? Looking back at 1988, 1989, 1990 times, when we were in a similar environment where our inflation went up and the interest rates started to go up, which caused a recession back in the early 90s as well. One of the things that the Bank of Canada did was sort of ease the interest rates going up and started to, bring them back down. And when one reflects on that, 20, 30 years later, however many years it's been, what they've noted is that maybe they eased too quickly. So they're learning from that. And that's one of the reasons the outlook, when we look at outlook, one of the reasons that many economists feel that interest rates will continue to rise, maybe one or two more times, and then hold steady, and then potentially start to come down again, moving into the late 2023, 2024. Again, total speculation. We don't have a crystal ball, but definitely when we look at, what economists are speaking of, we've started to see some trends as well. I'm just going to see if there's a chat here. Oh yeah, let's take a look. Let's see if I can multitask. I'm going to press pause here. I don't see anyone in the chat. I mean, in the waiting room, but I'll try to.
Perfect. Thank you.
Yeah. Okay. If anybody does see, I think everybody has access to kind of just admit. Oh, yeah, we do. There we go. I've admitted. Okay, perfect. Sorry about the delay. Some of the data that we've published around policy rate and mortgage rate, really, we look at different scenarios and how the Bank of Canada has definitely increased its policy interest rates again last week as well. And really just looking at what that brings for 2023 and 2024. And we are starting to see a definite, correlation to what's anticipated to what's actually occurring. What I've heard from key economists, both at CMHC and our collaborating economists, is that really looking at 2023 to be a stable year of what they call normalization and economic recovery, starting in the latter part of 2023, moving into 2024. And at the end of 2025, we're anticipating the 5-year fixed mortgage rate be between 5.37, 5.43. These are just obvious speculations, but definitely looking at ways that we can really make an impact with our clients, because it's the Canadians that you work with on a daily basis, where they really do rely on your support, your advice. And that's almost where, like, we don't have a crystal ball. Nobody did. If not, we'd all be, in a very different place today, both with our mortgages for those that have mortgages, and also with investments and home ownership as well. But what we can see is that the average house prices are definitely slowing down a little bit. It leads to higher unemployment, less wage growth. But what we have found is that unemployment has not gone up. So in that sense, what Benjamin Tal was mentioning at the Mortgage Professionals Canada National Conference is that a lot of the jobs that exist in Canada were for mostly educated individuals. So what he called university educated. So there's a huge gap in lower waged job opportunities. So I'll give you an example. I have a 14-year-old who just, started looking for work, and, the sky's the limit. Like, if you go to the mall, there's tons of opportunities to work. Again, these are lower waged jobs, right? And my son's only 14. So we're talking about what Benjamin Tal joked about is that there's no one to make our coffee, and we can't make it online. That's one of those things we really need a barista to do. So it's things like that really open the door to a more broad approach to what's truly happening in the environment. And that CMHC expected the increase in borrowing costs could definitely lead to a further slowdown in house price growth, moving towards our Q4 2022 and 2023. But as you can see in the chart, the national average price remains elevated, but it's set to decline by approximately 5% into mid-2023. We've also speculated that the national housing sales will also decline by 34% compared to their level in early 2022. So again, outlook, specifically mortgage rates eventually start to stabilize. We're anticipating in 2024, supported by rising household income, higher immigration. House prices are expected to return to positive but moderate growth. Oops, sorry about that. So here's a residential activity chart that we've put together for residential activity in Ontario. And as you can see, in terms of, just try to make this a little bit bigger. As you can see, when we're looking at residential sales, central, eastern, northern, we're really looking at, for central, Oakville, Milton, Greater Toronto area, there's been a year-over-year decline of 44%, bringing the residential average price to just over $1 million. Still, again, outside of CMHC's parameters in terms of an average, but there are still opportunities: Cornwall, Kingston, Ottawa, Renfrew County, St. Lawrence area at around 600,000. Bancroft, Barrie, etc., 777,000. So as you can see, there's been less impact on outside of the GTA core. I feel like the GTA core, based on this particular chart, showcases the largest year-over-year decline when looking at certain aspects of Ontario and Ontario as a whole. So definitely, I'm sure, you all working with your realtor partners have great access to even more information around this and zeroing into even tighter geographic areas. But definitely when looking at the total housing starts, when looking at that, it's evident that housing starts are expected to decline from their record levels in 2021 and even Q1 2022, but they still remain elevated in comparison to their long run average. So the downturn trend reflects the cooling impact of rising mortgage rates and the lower housing affordability. So what we've speculated here is that in the short run, housing starts are constrained by labor shortages, surging material costs, increasing financing costs due to rising interest rates. We all have, access to the news and things of that nature. We know that in order to develop in Ontario, in certain parts of Ontario, there are a lot of delays as well in terms of getting permits and things of that nature to develop. However, high price levels will continue to moderate housing starts, and in the long run, new home construction remains elevated compared to historical averages. So they're supported by high prices and population levels. Again, it really does depend on the type of development, but we still have a critical issue on our hands when it comes to solving Canada's housing affordability by 2030. Over the last 20 years in Canada, housing supply has not responded to demand, especially in some of the country's large urban areas, resulting in the loss of affordability. So again, stipulating that to restore affordability, an additional 3.5 million affordable housing units are needed by 2030. So we still have so much work to do. Number one, as an organization. Number two, partnering with our collaborators to look at what those delays, what impacts those delays have on the development of those affordable housing units, as well as the skill shortages, supply chain challenges, and an increase in supply will definitely put pressure on us restoring affordability by 2030. So when we look at population and migration, this is a chart again dated, I think it's 2019. I'm just looking. Yeah, 2019. When we look at migration in Canada, we can see both migration and immigration. We can see that the GTA is definitely going to see the largest population growth. It's also evident that even though immigrants tend to come to different parts of Canada, they do tend to migrate afterwards as well to large urban centers. So it's no surprise that I was speaking to a few newcomers to Canada a couple weeks ago, and they were telling me their story about their immigration to Canada and how some of their family immigrated directly to Sudbury, for example, and then slowly within just a couple years, they slowly started migrating to the Greater Toronto area. So I think that's a common vision for new to Canada immigrants that are just really seeking opportunities that are found in large urban centers as well. So another really interesting point that came from Benjamin Tell is when we look at the pandemic in 2020, 2021, he asked the crowd, and I was like one of those that fell for the wrong answer, but he asked the crowd and he said, okay, during the pandemic, which country was the number one country where Canada received 70% of their permanent residents from the immigrant sort of perspective? And everybody, India or China and all these countries kind of popped up. And Benjamin Tell said, no, you're all wrong. And we're like, what? We studied this, we know, and he said, you couldn't even, get on a train, a plane, or, a bus or a car for the most part. How did we get all those people in from other countries? They came from Canada. And we're like, what? So he talked about the fast tracking of non-permanent residents that were here on work permits to or study visas, university study visas, etc., that were fast-tracked and became permanent residents during the pandemic. So it was interesting that a large percentage of immigration during the pandemic actually came from people that were already living in Canada, working in Canada, and studying in Canada, and became part of our Canadian permanent residency platform. So I thought that was really interesting that I thought I could share. Again, really talking about net interprovincial migration in Ontario. Pre-pandemic, international migration accounted for 85.7% of population growth in Canada. In 2020, we saw international migration decrease by 80%. So Ontario has now experienced 6 consecutive quarters of positive net growth. However, we have record-breaking number of Ontarians chose to move out of the province for various reasons. So interprovincial migration really looks at, it could be driven by housing, it could be driven by opportunity, it could be driven by so many different components, but Ontario continues to be a popular choice for newcomers. International immigration added 66,455 people to Ontario's population in the first quarter of 2022. And really looking at where, definitely, you know, I had said India because I studied it, and I could see that, you know, the number of new immigrants arriving in Canada in 2019 by country of origin, 85.59 from India, second to China, third to Philippines, Nigeria, the US, Pakistan, Syria, etc., going all the way to Iran, etc. But what's interesting is that during the pandemic, the Canadian government did a lot to transition those on a work permit or study visa into permanent residency in Canada as well. So what does this mean for you, and how does CMHC come to the table to support you with your client conversations? When it comes to newcomers, our information on our website is in 8 different languages to support those new to Canada, to understand the dynamic perspective of home ownership in Canada, or just home management. Because even if you're renting, you have an obligation to understand what's happening in your home. You're going to need to turn the heat on. You're going to need to turn on if you have cooling. Definitely, you know, collaterals such as these are really there to help not only your journey with your clients that are coming into Canada as a newcomer, but also their journey to home ownership and home management, to support them with that. And what better way of educating your clients or giving them that knowledgeability within the language of their choice or their first language. It really does make a big impact. In terms of the programs that CMHC has, we have an excellent newcomer program. Again, your lenders, and Krista's here, but your lenders will be able to speak to their policies around newcomers. I can speak to our policies, and that is that if you are working with a permanent resident, they can absolutely showcase alternative sources of establishing creditworthiness. And if they are non-permanent residents, so they're here with a work permit, they have access to showcase sources of verifying creditworthiness as well, using an international credit report, a letter of reference from previous financial institution as well. CMHC financing is available to both permanent and non-permanent residents. If you are working with a non-permanent resident, they do need to put down 10%, not 5%. But a permanent resident qualifies for the exact same programs as a Canadian citizen. There's no difference. They're able to purchase with as little as 5% down. We have no minimum or maximum period of residency to qualify. So again, if your lenders that you're working with do have policies, their policies will always supersede ours. But the benefits of the program are really access to homeownership sooner. They don't have to save the full 20% to purchase a home in Canada. They can purchase a home in Canada with as little as 5% down for permanent residents and 10% down for non-permanent residents. And we will work with the lender to identify alternative ways of establishing credit. So
Sorry,
here,
just to add is a point
yeah,
there for you, Monica, there.
absolutely.
For our realtor partners on the call, the guidelines may not be specific that you need to memorize, but for, the question of whether or not the client has a PR card or not is a great avenue to kind of be able to help direct them to the next step. Ultimately, myself as a mortgage agent or mortgage broker, as well as the immigration lawyer, will help them to that next phase. But if we as partners can get that client information, if they have PR or not, that'll really help designate. We have quite a few realtors that are either listening on the call now or had asked for their recording. So just really isolating the PR card to simplify it, or no PR card, helps us to be able to direct to the correct lender and program.
That's fantastic. Absolutely. It's a great way to really showcase the value that you bring, that you understand the difference, and that you're going to navigate the right options for them depending on their status as well. So here's a question for you guys. What is the number of households in Canada participating in the first-time home buyer incentive? So I'll speak to that program as well, because I think it's really important to just bring forward some of the opportunities that may come out of this increased immigration, as well as the opportunities with more, somewhat more affordable homes to be purchased as well. So any guesses? I can take a look at the chat here.
Is this all across Canada?
Yes.
Oh gosh, I don't know. So the first time homebuyer incentive, for those of you who don't know, is a program that our default insurance partners allow for part of the down payment to be granted to the owner participant. And it's basically an equity share program whereby when you sell the property later as a client, you would pay back that down payment portion to Cmhc, for example. So in the case of first-time homebuyer incentive, 5% if it is an existing home, and up to 10% if it's new construction. Is that correct, Monica?
Yeah, so it doesn't actually they don't pay us back. It's the government of Canada.
The government of Canada.
We'll monitor the program because there is a mortgage loan insurance component to it. So you have to, in order to do this equity share, you have to purchase with as little as 5% down. So you have to negotiate a mortgage loan insurance. It has to be mortgage loan insured in order to qualify. So I do see that Michelina Dos Santos says C. Michelle says, sorry, Michelina says D. Michelle says C. And it's amazing because I have the answer like right here. I tried to hide it, but it is in fact 15,000. So the number of households in Canada participating in the first-time home buyer incentive is 15,000. So if you don't know about it, you're going to hear about it today. If you do know about it, keep talking about it, because it's not for everybody, but it is an opportunity for those first-time home buyers to at least navigate whether it's something they want to engage in or not. And you being their mortgage professional, they want to hear about it from you, I'm sure. So the first-time home buyer incentive, what does it mean? What does it mean? It provides up to $1.25 billion over 3 years to eligible home buyers by sharing the cost of the mortgage. So the program allows eligible first-time home buyers who have a minimum down payment for an insured mortgage to apply to finance a portion of their home purchase through a form of shared equity with the government of Canada. For the purchase of an existing home or mobile manufactured home, an incentive amount is 5% is available. If they're purchasing a brand new construction, so whether it be condo or regular, town, semi detached, an incentive amount is between 5 or 10% of the available is available to qualified buyers. So in terms of this particular program, here are the advantages. And I use really, really simple math to make sense. So your clients purchase a home, and I close my eyes and imagine this. They purchase a home for $100,000, right? They put 5% down. So they put $5,000 from their savings account, and they tell their financial institution, you know, I'm going to put this $5,000. They're going to get mortgage loan insurance for this purchase, right? If they decide and they qualify for the first-time home buyer incentive, and let's say they bought a brand new construction, the government will say, okay, great, I will engage in this shared equity, and I, the government, will put down $10,000. And again, I'm using simple math. So now what happens? Homeowners now have a down payment of $15,000 according to the bank. So what it does is it reduces their mortgage payment, right? Because they now have $15,000 or 15% down. And guess what? Their mortgage loan insurance premium isn't calculated using the loan to value of 5% down. It's now calculated based on the loan to value of 15% down. So it reduces the insurance premium, it reduces the mortgage payment, and what it does is it increases their ability to afford more or to be able to have a higher level of affordability with their mortgage. So increase their purchase price, for example. They can decide between a 1-bedroom and a 2-bedroom condo. They can potentially afford, a 2-bedroom, for argument's sake, or a 1+10, whatever the components are, because of the shared equity. So these are the advantages to the program. There is so much more information on the internet on cmhc.ca. If you just type in first-time home buyer incentive, it'll all populate up. There's a 1-800 number to call to be able to call and ask any questions you may have or anything of that nature. I'm just going to take a look at the chat. Okay. Awesome.
If anyone on the call, any of our realtor partners that are on the call have any specific questions about this incentive, we can always one-on-one talk about your particular clients. You don't have to call, I will call for you, don't worry. Yeah, if you have any questions, if you think you have a buyer that could be a good fit for this program, we can certainly go over the pros and cons and really hammer out the cash flow positive solutions, that comparison with and without the incentive for your specific situation. So again, if you're a realtor on the call, you definitely don't have to pick up the phone. I can do that for you, and then I can hash it out with your particular file, no problem.
Sounds wonderful. I just thought I'd mention Alejandro's question here now, because I think it fits perfectly. So we saw that during the pandemic, CMHC pulled back on their ratios. Does CMHC foresee any changes to their GDS, TDS ratios should we enter into a recession of 2023? Changes to, oops, sorry. Or changes to the stress test by OSFI later this year? Gosh, it's a great question. In terms of what CMHC did an analysis at the beginning of the pandemic, and I think, and I know I'm being recorded here, so I'll be very careful, but I think we didn't anticipate what happened to the housing market during the pandemic. I think similar to what you're thinking about a recession is going to happen, you're going to think, okay, it's a recession, housing prices are going to go down, interest rates are going to go up. You kind of have this vision of what a recession would mean in your professional opinion. And I think CMHC did an analysis of what they thought the pandemic would do to housing, and felt that they should make changes to the GDS and TDS ratios, making it more stringent and making it more difficult to qualify because of the fear that the pandemic was going to cause issues with default, for example. So what the government, or what CMHC did, was change the parameters and made the minimum credit score 680 and made the GDS and TDS higher, which meant it was harder for people to qualify. Back in 2020, July, CMHC 2021, my apologies, the government made a decision to change the credit, the debt service ratio and credit score guidelines back to where they were pre-pandemic. So that's where they've been since 2021. And they are minimum credit score of 600, GDS of 39, TDS of 44, can't exceed that. So do we foresee any changes to that? We have not heard anything. I think it's a little too quick to make any of those assumptions right now, just because of the volatility of the mortgage of the Bank of Canada overnight lending rate. And I think that once things stabilize, we should start to hear more into probably Q1 2023. And if I do hear anything, I'll be the first one to send you an email and let you guys know if there's any changes. But we haven't heard of anything at this point because we're still trying to evaluate the impacts, the potential impacts, to your point, of a potential recession. So no changes have been made at this time. I'm sure there's a lot of conversations going on behind the scenes, but we haven't been made aware of any of them to date.
And again, just for our realtor partners on the call, those are specifically talking about what we utilize as mortgage professionals to qualify your clients. So we have a portion or a percentage that we are allocated to utilize for total debt as well as housing debt. So those are what we are using when we talk about GDS and TDS. Those are the qualifying parameters that our lenders, as well as our default insurers like Cmhc, utilize to assess a client's worthiness of maintaining their purchase power.
Thank you so much. That's perfect. So here are some of the programs that I think I can go a little quicker. It's 12:07. In terms of some of the programs I thought I'd make you aware of, we have, most of you probably already know about it, but a CMHC improvement program. Basically, you access more financing options for home improvements. So if the as improved value and the mortgage plus the improvement amount does not exceed $1 million, there's an opportunity for the improvement costs or the improvement amount to be added to the mortgage. So I guess question for you guys, what is the percentage of homes in Canada that are over 20 years old? And I know you can see my screen. So believe it or not, the percentage of homes in Canada that are over 20 years old is 79%. So 79% of homes in Canada, I can't believe this, but it's so true, are over 20 years old. For those of you that have a home or, you know, a townhome, a condo, whatnot, take a look at your kitchen, right? Like you look at the kitchen, and my kitchen is 7 years old. I tell you, there are so many nicks and drawers that just don't close and things like that. And that's at 7 years old. So I can imagine what is needed to a home after 20 years. So when looking at improvements, definitely, you know, kitchens, bathrooms, windows and doors to make things more energy efficient as well, will really not only increase the value of a home, but also give you a better living, you know, a living experience in your home, right? Like functionality, so to speak. So when we look at the existing stock in Canada, you can see that there's still 10% of homes that were built before 1946, 1946 to 1960, 12%. A large majority, I'd say, you know, between these three components, built between 1961, 1980, a huge percentage, 30, followed by 1981 to 2000, and that as well is followed by 2000 to 2016. So when looking at the average home, what do you think of the age and type of home you can buy for 400 to 500,000 in today's market? It's very, very difficult to find, but if you find it, most likely you'll need to do some repairs, right? And that could mean structural, that could mean, you know, what am I trying to say? Like cosmetic.
Cosmetic,
Yeah,
yeah.
I couldn't get that word out. Cosmetic changes as well. Those can all go added into the purchase price. Sorry, the purchase price, the mortgage price, right? So you're not paying, you know, a Visa card by Home Depot or wherever you buy like supplies and things like that, and not paying 22, 29, 28%. But you're paying your mortgage your mortgage over the course of your amortization, 25 years or whatever the case may be. So 77% of mortgage consumers plan to renovate in the next 5 years. So we found this from our 2022 mortgage consumer survey. And I guess the question is, if you're planning to renovate in the next 5 years, where are you going to get that money? Because we all know you buy a new home and there's so many demands, especially in the first couple of years of home ownership, whether it be cosmetic or maybe not as much structural, unless you're buying a home that needs, repair. But, you know, even just on my street with some of the storms that have happened, you know, shingles have flown off. Things have happened to homes that you just don't expect it. You just never think that that's going to happen. Or a shingle, you know, flies and hits something and damages it. You need to fix it, or whatever the case may be. So why not look at working with your clients, if they can, if it meets the parameters, on an opportunity to add that renovation right at the very beginning upon the first purchase and whatnot, and fixing the home so that they can enjoy that new kitchen, that new bathroom, fresh paint on the walls, new windows, whatever the case may be. Sorry. 69% of mortgage consumers were aware that renovation costs can be incorporated into their mortgage. But what about the rest? Like, how many people didn't know that you can add renovations into your mortgage? Again, these are not, like, when we're looking at CMHC, we're still looking at less than $1 million. So, you know, there's I'm sure specific clients that fit that niche, but it's just knowing that it's available to them and being, you know, the ones to provide that opportunity as well. So definitely, you know, the benefits for just going, I don't know why my slide's so small. There we go. Definitely start their improvements sooner, get their wish list done sooner, use savings for other priorities, retirement, rainy day funds, emergencies, maybe even savings. Keep repairs affordable with potentially lower mortgage rates. Well, yes and no, it depends on when they plan on doing this, and provide peace of mind, one payment included in the mortgage, so they're not paying so many different options. So there are definite advantages to this program, and really looks at, you know, the capabilities of you as mortgage professionals to support your clients with their home ownership or home management dreams. We also support self-employed individuals as well. I believe we're the only mortgage loan insurer that will work with self-employed individuals that are self-employed for less than 2 years. Again, the lender policy will always supersede ours, but you know, we don't want to penalize a self-employed borrower just because they're self-employed and charge them a higher premium because they're self-employed. So we charge the exact same premium based on loan to value, regardless of their employment status. So there's no added amount. So I guess question for you, what is the percentage of self-employed Canadians in Canada? Where's the opportunity when we're looking at self-employed Canadians? How many do you think we have? Take a look at the chat quickly. B, 15%. Let's see if that was, yeah. Oops. While you guys are typing your answers, Alejandro just asked if there'll be any changes. We don't know of any. That this particular, when we look at single income friendly, will there be any changes to the incentives? We don't manage it. We do manage the program, but we're not in charge of making specific changes. That's done with collaboration with the government of Canada. So as soon as any of that is published, it'd be available to all three insurers as well through the first time home buyer incentive plan. So if any changes do happen, keep an eye on the website, because that's where you're going to find out more. And changes do happen pretty often with that program as well. So definitely keep an eye out for that particular program. And if there are any changes, you'll see them online. One of the things we really pride ourselves is if something happens, let's say tomorrow, and you negotiated a client into the first time home buyer incentive today, we have looked at looking back and saying, can we look back on any of the situations that maybe didn't get as much of a favorable outcome, and is there any way to relook at the situation? So we've done that in the past, so don't ever feel like there might be an opportunity, there might be a change today, there might be a change tomorrow, but just keep a tally of who you're working with on these, and make sure you let them know what's happening with that program and how it can work to their benefit if they choose that particular shared equity program, and then work with the managers of that program, the first time home buyer incentive, to talk about how it impacted your clients and whatnot. So you can always have that open conversation. So we got a variety of different questions here. The answer is B, 15%. So they're self-employed Canadians are key contributors to a strong and vibrant community, and they represent a significant portion of the Canadian workforce. So we definitely support self-employed individuals. They can access any other program at CMHC, so it's stackable with any. So for example, CMHC improvements or newcomer. We offer additional flexibilities to lenders considering self-employed borrowers who've been operating their business for less than 24 months, or they've been in the same line of work for less than 24 months. So really, keeping a real handle on what's the opportunity for self-employed borrowers. I think that's increased a lot during the pandemic as well. And there may be opportunities to work with them and to help them through their home journey as well. So when we look at, overall, what we talked about today, we've really looked at the opportunities. Sorry, my slide just keeps popping up. We really look at the opportunities that are brought forward with this changing environment. We have a full range of mortgage loan insurance products that you can access via your lenders and working with your partners. Our website is a great place to kind of start and look for opportunities with your clients, whatever situation they may be in, whether they're new to Canada, they're self-employed, they want to do improvements to their homes. We can work with you on any of those opportunities. And if you have any questions on CMHC, we have an excellent 1-888-GO-EMILY line, and I can put that in the chat as well, where you can contact and reach a live underwriter right away, so that you can speak through your specific situation with your client and ensure that they have the opportunity to understand what opportunities that may arise from a mortgage loan insurance perspective. So I'll stop sharing here and I'll come back to the screen.
And that 1-800 number, again, just for the realtor partners. So this is all realtors on the call today. When my realtor partners often will say to me, is this property going to have a problem? Will it be able to be insured? And that telephone number is a great opportunity to call and see if there's, anything with the property, specifically condos. If you are curious about a condo and if a lender will lend on it, great opportunity to speak to a underwriter at CMHC to understand that property. to see if there'd be any problems before you have to physically go there and see the property itself.
Yeah, so we made some changes to that where we've, what was happening was we were holding on to information, and then let's just say it ended up getting rectified. We didn't get all the information right away. So what was happening was sometimes it didn't work to everybody's advantage that way. So we've changed that particular process just a little bit, whereby if the deal is active with a lender, that's the only time we'll release information, because what was happening is we were compiling so much information based on what you would be sharing, Emily, or what realtor partners would be sharing. And then we had a false reality with specific units. So now if that does come up where you're questioning a specific property, the only time we're managing information on that property is if it's a live application. So I would encourage, working with your lender partners, if you do have a live deal, that's the only time we'll release information on that property, because we just weren't, I don't think it was working to everybody's advantage.
Makes sense.
Yeah.
Do any of our realtor partners have any questions that you'd like to ask Monica about CMHC and kind of projections going, or into Krista as well at First National, if you have any questions that you're seeing or clarifying? Where are we for time? I think we're right on time, a little bit early, so we can give our friends here 8 minutes back. If no questions. I want to thank you, Monica. Krista, did you have anything you would like to add, or are we?
No, great job, Monica. It was really, really informative and awesome. And for the realtor partners on the call, First Nat supports the products and the information that Monica was passing along. So if you need anything, reach out to Em. We're all here to support you guys.
Thank you, Krista. Thank you, Monica. I really appreciate your time. I always find that having a market update is so important. One of the things that I like to take away from these types of things is we always hear the doom and gloom in the media, and sometimes it's nice to hear numbers that are accurate and reflective of what really is happening on the ground. And you see so many files on such a regular basis that you would have a much stronger understanding of what really we are experiencing from a purchasing perspective. I think one of the benefits that we are seeing from lower price points is there will be more business that are coming through the under $1 million option. So that's going to allow a lot more buyers, first-time buyers specifically, get into the market, which is amazing and wonderful for, Canadians in general, and as well for newcomers, as you mentioned. So I think for me, the takeaway was the normalization factor of the 5.37 to 5.43 range that we're going to probably end up seeing. Again, no crystal balls, but when my realtor partners ask me what we think we'll be seeing, in that 5.5 range is realistic, I think, for 2025. And I totally agree with you. That is a more normalization of what we were seeing. If you, myself, for example, have been in the industry since 2008, that is a reasonable rate to see for repayment, and not, bananas that we saw in the low ones. Some 0.99 rate we saw in pandemic at some of our lender partners on the variables. So I think that we will see and the other takeaway, the continuing to slow, but not necessarily fall off. We will see a slow. So if you are in the real estate market, as you would be if you're on this call, to, brace yourself and prepare yourself, but be that positive light to our buyer clients, that you can support them and say that this is slowing, but it's not over. People still need to buy homes, and they need very smart, very kind professionals to lead them into a strong and solid 2023 and beyond. So I appreciate you taking the time and to give us a different perspective than, that doom and gloom that we do see out there. And I do appreciate it coming from someone who sees so many multiple files on a very regular basis. So thank you. Thank you for your time.
My pleasure. Thank you, everyone. Thanks for organizing it, and we'll speak to you soon. Have a great day.
Okay, thank you. Have a wonderful day. Thanks, Krista.
Thank you.